So how do you play it from here? For more, let's bring in Joshua Shanker, Senior Insurance Analyst at BofA Securities. Josh, it's great to see you today. I mean, it's been a very good year. The rates are part of the story. The return on equities for insurers is part of the story. But why do you think that they are, or how do you think they are positioned going into 2025?
Well, first of all, thank you for having me on, Contessa. I want to say about the return on equity. Well, going into 2025, it's going to be quite excellent. But it's been a hard few years for these insurance companies. If you recall, auto, which drives a lot of this, everyone started driving again after the pandemic, and it caught the insurance companies off guard, especially when inflation started to incur simultaneously. And they had to increase rates a lot. If you have been paying out of pocket for your insurance, you know that the cost of your insurance is going to fly a lot over the last few years. But that's because the insurance companies weren't making any money on you early on. Now, for 2 years of very significant rate increases, the most significant in probably 50 years, these companies have moved to a place where they will be profitable in 2025. And while that hurts the wallets of the average American, the insurance companies can't not make money. They're in this to make money. That's why they do the business.
And the other thing,
some people are saying, well, gee, now, yeah,
go ahead. Well,
no, I was saying that some are saying, look, they've made enough money here. Can they cut prices? It tends to be the case that pricing almost never goes down.
Right.
But we should expect going forward that there's some flattishness.
It's interesting because Allstate said on its most recent earnings call that after 2 years of price hikes that accounted for like 40% over 2 years in total, they were starting to see some retention issues, meaning people were starting to shop around for other car insurance. And when you have had rates increasing the way they have been, it means more people, more companies are interested in getting into, for instance, auto insurance. We're seeing the same thing in reinsurance, right? The reinsurance rates have skyrocketed. You get more companies saying, you know what, it seems like a pretty profitable business to be in, and the competition then drives down those rates a little bit. So it's so weird when you talk about insurance because we want to talk about the investment side of it and the potential to make money, but everyone watching also has a personal stake, whether it's for the business that they're running or for their home and auto, a personal stake in how much you're paying.
I think that's right. Look, in terms of new incumbents coming in, do you trust the brand that you've never heard of before when you're going to buy insurance? And so a new company can come in and say, hey, look, we'll offer you cheap insurance, but you've never heard of that company. You may not want to buy. That's like building a trusted brand. And companies like Progressive or Geico or Allstate or State Farm spend billions upon billions of dollars over multi-year periods, some even in a single year, in order to create knowledge of the brand. And two, you have to have a long track record of paying claims. But one of the funny things is you can win a lot of business by having the cheapest prices, but also if you have the cheapest prices, you may not be making any money. So one of the funny things about insurance is that it's easy to grow and write a lot of business. And it's not always hard to make money, but it's almost impossible to do both simultaneously.